We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. A global risk-on wave ripped through markets as investors doubled down on one idea. The Fed is done hiking, and a cut may land as early as December. U.S. equities surged with small caps leading the charge, a clear bet on falling borrowing costs, even as retail sales and consumer demand flashed early cycle slowdown warnings. Europe rallied on a powerful disinflation pulse, pushing Eurozone CPI toward 2.2%, though weak German business sentiment and the UK's austerity-tilted budget cast shadows over the recovery. And in Asia, Japan's rally priced in the end of deflation, while China's tech-driven bounce stood in stark contrast to sliding industrial profits. A reminder that fundamentals haven't caught up with the hype. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering. Not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
Our mission today is pretty simple. We are cutting through all the noise from the last 5 trading days. We want to deliver the most important nuggets of knowledge, the information you actually need to be ready for the week ahead. So this is a rapid-fire global market recap, a look at what really drove prices, and then the 5 defining risks coming right at us.
And if I had to sum up the week, in one theme, it was this remarkable period of, optimism. Markets were giving thanks. And not just for the holiday in the U.S., it was for a powerful global rally that was really driven by one single idea, the growing consensus that the Federal Reserve is done hiking rates and is maybe, just maybe, looking at a cut as soon as December.
That is a huge shift in sentiment from just a few weeks ago.
It really is. And this optimism was fueled by a kind of cocktail of inputs. You had these dovish signals from central bankers, you had cooling economic data, and clear signs of a softening labor market. That blend just created the sense of certainty for investors that easing is on the way, and that lifted equities everywhere, even when some of the underlying facts were, frankly, a little worrying.
Okay, let's unpack that. Let's start where the biggest gains were. The U.S., the markets absolutely roared back. They shook off all those previous jitters. We're talking the S&P 500 up a very strong 3.73%. The tech-heavy NASDAQ flying up 4.91%. But the really surprising signal, the one that tells you exactly what investors are betting on, was the smaller caps, the Russell 2000. It led the entire charge, up a massive 5.52%.
The small caps leading is the key headline there, absolutely, because those companies, they are so sensitive to interest rates, to financing costs, so their huge gains are, a clear proxy for the market's conviction that borrowing costs are headed down. And what's fascinating is that the engine behind this move wasn't necessarily, strong economic data. It was the explicit dovish commentary from key Fed officials.
So it's the belief in cheaper money that's the driver. But when you look at the actual economic scorecard, the data was, it was a pretty glaring contradiction, what we sometimes call the tale of two economies.
Precisely. We have to drill into that contradiction. On one hand, you saw this remarkable resilience in the labor market. Jobless claims, which is a good gauge of job losses, actually hit a 7-month low.
A 7-month low.
Which signals employers are still holding on to their people. That's a strength signal. But then you get the counterpoint, the September retail sales data. And that pointed squarely to softening consumer demand.
And this wasn't just a minor dip in shopping, right? The control group sales number, which is so crucial because it's a direct input for U.S. GDP, it actually fell for the month.
Yeah.
So wait a minute, how do you reconcile that? A 7-month low in joblessness, but consumers are suddenly pulling back their spending. Isn't the labor market supposed to be the best indicator of consumer health?
That is the central tension right now. The market is processing 2 completely conflicting signals. You have to remember, labor is a lagging indicator. Consumer demand is much more current. And we also got the Fed's own snapshot, the Beige Book, which reported a very mixed picture. They noted modest price gains, but declining employment in some regions, localized weakness. And at the same time, they said cost pressures, often from tariffs, were still stubbornly high in manufacturing and retail. That's a really tough environment. Rising costs, slowing demand.
So it sounds like businesses are getting squeezed on both sides, costs and revenue, but they just haven't started shedding jobs in a big way yet.
Exactly. And the risk is that the labor market eventually catches up to that consumer weakness. But for now, the bond market has picked a side. It's betting easing is coming. Treasuries gained, yields fell across the board, and that just solidifies the consensus that the hiking cycle is over. So for you listening, the key takeaway is that this rally is built on policy hopes. The market is prioritizing that over some pretty worrying consumer data that could foreshadow a real Q4 slowdown.
Let's transition then. Across the Atlantic, European markets saw a similar rush of enthusiasm. The STOXX 600 gained 2.35%. And this rally was supported by one key factor. Inflation is easing, and that just helps the European Central Bank, the ECB, stick to its current pause.
The disinflation momentum in the Eurozone is real. It's a strong tailwind. We saw very modest price increases coming out of France, Spain, Italy, and crucially, the flash CPI number for the whole Eurozone is expected to land very, very close to 2.2%.
And 2.2% is huge. That brings the ECB so close to its 2% target without having to hike rates again. That's pretty much the best-case scenario for them.
It gives them breathing room, definitely. But it wasn't a completely smooth picture everywhere. Germany, Europe's engine, showed a really interesting split. The IFO Business Climate Index, which is a key gauge of corporate sentiment, it fell unexpectedly. That signals ongoing pessimism from executives. They are bracing for a recession.
But I thought consumer confidence rose a bit in Germany.
It did, and that's the divergence. Households are feeling a little better, maybe because energy costs are falling, but the corporations are nervous, and that suggests a major disconnect between the industrial sector and, the average person's outlook.
Okay, but this is where the story, for me at least, gets really interesting. The real shockwave came out of the UK, the budget. Chancellor Wiese delivered what was basically a massive GBP 26 billion package of tax hikes and spending cuts. It was austerity, just with a different name.
The fallout was immediate. And the analysis from the Office for Budget Responsibility, the OBR, was pretty stark. They warned very clearly that this tax package will drag down long-term growth. And it's projected to push the overall tax burden to a staggering 30-year high by 2030.
A 30-year high.
It's that classic political trade-off, right? Tackle a deficit now, but at the expense of potential growth later. It's hard to see how that doesn't sap confidence.
So what's the big picture for Europe then? Softer inflation is great news for the ECB, no doubt. But these tax-heavy budgets in places like the UK, combined with that really weak business sentiment, it just casts a very long shadow on the recovery story, doesn't it? The optimism feels fragile there.
Now, turning to Asia, we saw two very different, but I think equally compelling stories. Let's start with Japan. Japanese stocks rallied hard. The Nikkei 225 was up 3.35%. This market is finally positioning for the end of the lowflation era.
It really feels like we've been waiting for this moment forever. What's the specific data that's finally giving investors confidence that the Bank of Japan, the BOJINE, is ready to move?
Well, we have several inputs now. The key Tokyo core CPI is still elevated at 2.8%, which keeps the BOJ on its toes. It shows that price momentum is persistent. And on the growth side, strong October retail sales, strong industrial production. They are both bolstering recovery hopes. And crucially, the financial markets are reacting. The 10-year Japanese government bond yield, the JGB, rose to 1.82%. That's approaching 17-year highs. And that has seriously accelerated the chatter that a rate hike could come as soon as December.
A rate hike in Japan after all this time, that's massive for global finance. But this push toward normalization, it comes with a pretty big and, frankly, confusing caveat, doesn't it? The fiscal risk. We just saw a massive JPY 21.3 trillion stimulus package announced. So how do you even square that? You have impending monetary tightening with such aggressive fiscal spending, it feels completely at odds.
That is the trillion yen question. It's a very unusual policy mix. The monetary arm, the BOJ, is tightening, while the fiscal arm, the government, is stimulating. It raises really important questions about fiscal sustainability. Is the government just undoing the BOJ's work? Investors are focused on this duality. They love the end of deflation, but they're very cautious about the government's spending habits.
Okay, now let's look at China. Always a tough read. Despite what felt like gloomier macro data, Chinese equities still gained. The CSI 300 was up 1.64%. The rally there seems almost fundamentally disconnected from the reality on the ground.
The disconnect is striking. The rally in China is being driven heavily by AI and tech enthusiasm. It's mirroring that global momentum we saw in the US. Investors are betting on long-term disruption, future stimulus. But the reality check came from industrial profits. They fell 5.5% year over year in October. And that ended what had been a brief 2-month rebound.
So the stock market is excited about the future of tech, but the actual factories are still struggling with margins and falling profits. It's a classic case of tech running way ahead of the fundamentals.
Exactly. And even though the real economy signals are flashing yellow softening property data, weak industrial data, most analysts are still sticking to the idea that China will hit its 5% growth target for 2025. This means investors are betting on two things: disruption and a large guaranteed government backstop. But if that data continues to worsen, especially the factory data, that tech rally is going to become very vulnerable.
Time to pivot then. Let's look ahead. We're moving into the first week of December, and it is bringing a crucial wave of economic data that is going to seriously test this rally we've been talking about. This is the week where the hope from November either gets validated or, well, shattered.
The calendar is packed, especially Friday. That's going to be the volatility event of the week. In the U.S., we start with ISM manufacturing on Monday, then ISM services on Wednesday. But the grand finale on Friday is the core PCE price index. That's the Fed's preferred inflation gauge, along with personal income and spending, and the Michigan Consumer Sentiment Survey.
And across the pond, Tuesday is critical for the Eurozone flash inflation rate. And China starts the week early on Monday with its official NBS and the private cakes and manufacturing PMIs. That's a lot of potential triggers.
Which is precisely why you need a roadmap. So you've distilled it down to 5 critical risks that could trigger serious volatility this week. These are the flashpoints to be laser focused on. Risk number 1, a Fed flip-flop on the December cut.
Why does that matter so much right now?
Well, because markets have priced in a very, very high probability of easing early next year. Any hawkish pushback or data that suggests inflation is sticky could instantly rattle risk assets. So what to watch is that core PCE inflation print on Friday. If it comes in hot, that whole rate cut narrative evaporates, and you'll see an instant correction in small caps and tech.
Okay, risk number 2 has to be a Eurozone inflation surprise. Why it matters is the ECB is enjoying its pause, confident inflation is heading to 2.2%. But if Tuesday's flash CPI comes in higher, say 2.5%, 2.6%, it throws their whole dovish plan into jeopardy. It raises the possibility of another rate hike, and that uncertainty would hit European equities hard. So you have to watch Tuesday's flash CPI reading.
Risk number 3, China PMI disappointment. As we just said, the Chinese tech rally is running ahead of macro reality. So weak factory data on Monday, either from the official NBS or the cakes and PMI, could undercut that enthusiasm fast. Weak PMIs signal weak global demand, weak commodity consumption, and that sends a negative ripple through materials and industrial stocks everywhere. So watch those Monday PMIs.
Risk number 4 takes us back to Japan. A BOJ policy shift. Why this matters so much is that higher inflation and rising yields have really revived those rate hike bets. Any change in guidance from the BOJ or a sharp move in the JGB yield could profoundly shake global bond markets. If they tighten sooner than expected, capital starts moving back to Japan, strengthening the yen and impacting global financial flows. You have to watch BOJ commentary and that 10-year JGB yield.
And finally, risk number 5, consumer fatigue in the U.S. We saw that softening retail data last week. The personal spending data on Friday is the definitive sign of whether the U.S. consumer is finally retrenching. If spending drops more than expected, it validates fears of a serious Q4 slowdown, and that forces a downward revision of corporate earnings. So watch Friday's income and spending data, especially the spending part.
So what does this all mean for you, whether you're an investor or just someone trying to understand the market's momentum?
Well, November closed with this powerful surge of optimism, driven almost purely by the hope of central bank easing. But that core tension we observe everywhere remains unresolved. It's this constant tug-of-war between cooling growth signals, the consumer pulling back, industrial profits falling, and the market's certainty about future policy.
Exactly. And this coming week is the test. So the question I want to leave you with, and it's the one we started with, really, is this. We saw jobless claims hit a 7-month low, signaling a strong labor market. At the same time, core retail sales fell, suggesting the consumer's already pulling back. So how long can the labor market stay this resilient if the U.S. consumer is starting to retrench? Is the current rally built on actual durable economic strength, or is it just built on the fragile hope of cheaper money that could vanish with one hot inflation report? Keep that question in mind as you process Friday's data drop. We'll be here next week for the debrief.
Still watching? Then you're one of us. someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.